don't know. We're going to leave the cool music behind. Here we go. So welcome to the Building Doctor Show. I am your host, Jens Johansson, and I'm glad to see you here to learn more about your buildings. This show is about sharing information and resources for you to keep your buildings in good condition and therefore maximum value, and also keep your community happy and not fighting with one another. Everyone knows your home can get emotional, and we want to be here to help you navigate that. In today's show, we've got 7 questions that were submitted throughout the month, and several of those relate to last month's topic, the Fannie Freddie Mac loan requirements. And so that's kind of the big thing in the industry right now. So we're going to continue to cover that. But today's guest is Jill Jones from Columbia Bank, and we will be talking about the commercial loan side of things. If you're going to do repairs or other types of commercial things versus the mortgage lending. And we're going to talk about how those requirements all integrate into a good reserve study and a good plan for your community and how you get things taken care of. So it's one big topic that the boards need to know more about. So stay tuned. Today's show is sponsored by J2 Building Consultants. We're a fantastic group of engineers, designers, and project managers that help diagnose, prescribe, and treat sick buildings. So just like a doctor, we diagnose the problem, prescribe the right plan, and help you treat the problem by overseeing the contractors to make sure they put it back together correctly. You can find J2 in Seattle, Washington, Portland, Oregon, and Salt Lake City, Utah, and the surrounding states. And you can also find them on the web at j2consultants.com. Today's guest, like I said before, is Jill Jones, Vice President, Senior Community Association Lending Officer at Columbia Bank. Jill is an experienced lender specializing in financing solutions to homeowners and condo associations throughout the state of Washington. Welcome, Jill. What can you tell us about yourself?
Thanks, Jens. Happy to be here. Well, like you said, I am an HOA lender. That's what I specialize in and all I do. Columbia's been offering association loans for well over 20 years. Pretty much same footprint as you, Washington, Oregon, Idaho, and Utah, and soon to be heading out nationally.
Awesome. Now, you mentioned Alaska. Do you work primarily West Coast or Pacific Northwest, or is it?
Primarily West Coast. Yes, absolutely.
Okay, perfect. And we have worked with you in all 3 states, and Columbia and yourself are fantastic partners in this. So welcome. All right. Now that you know who we are, we're going to do a little poll and find out who you guys are. So this will help us tailor the questions to understand who's in the audience. You know, are you board members? Are you managers? Are you just residents? Maybe you're contractors and partners yourself. So while you're filling that out, we're going to continue to go through some of this format and other items here. So the format of this show is webinar based, so you can attend live and ask Q&A for your live Q&A questions, but you can also submit your questions online all month and watch it later, and even forward this to your board or other owners for their benefit. And I'm just looking at the numbers. I know 40 registered and there's 9 of us on here. So, you know, we get it. This show is during work hours, and if your boss catches you watching YouTube, you might get in trouble. So anyway, if you're like me, I like to watch my shows on Sunday afternoon and kind of hit the catch up button. So this format also gives us kind of some ability to share some photographs or even get out a whiteboard and draw some things out for you that are really useful during that Q&A session. It's a little bit more serious than some of our content you'll see on social channels, all the big ones, YouTube and Facebook, Instagram, all that stuff. Look for J2 Consultants and you'll find us. So I'm going to wrap up the poll and share those results. We've got Washington, Oregon, other. That's good. Let's see. We've got lots of board members. That's good. How'd you hear about us? That's great. Has your project been through a repair project before? Yes, a small one. No. So people are finding out more information. And that's exactly what we're trying to do here. So we'll stop sharing that poll. let's get into the disclaimers, the lawyers and insurance agents of the world. So this show is free, so put away your credit cards. We aren't selling you anything. And this show is for educational content only. We, Jill and I, are not giving legal, financial, or engineering advice, and I'm not a medical doctor. We're just people on the internet trying to help you run your building better. And we've helped thousands of people with their building problems, and we have seen what worked and what didn't when it comes to restoring and financing these restoration projects. And we want to share that experience with you in hopes that it benefits you. So feel free to ask for either of our CV in the chat, and Brooke, our producer, will put that in there. And that's a little bit of the description there. The chat is to talk, ask little questions. The Q&A is for your put your live questions in there, and Brooke will be moderating that, and we'll get that to the end of those items. So let's get into this today. Today is episode 4, end of June 2022. Jill, anything exciting going on in your world? Are you staying cool in our Pacific Northwest heat wave here?
Hey, very cool. Not a lot going on.
Good. We're getting ready for this weekend is 4th of July. That'll be fun. So, but this end of this week is end of the first half of 2022. So it seems like it's going fast. So anyway, we have 7 questions submitted this month. And again, I think 4 of them are talking about the Fannie Mae. So the first 3 we'll cover as general, and then we will get in more into that Fannie Mae loan requirements and how the commercial loans work into that, and we'll help understand that. So after those 7 questions, stick around for the live Q&A session, as well as some raffle giveaways at the end. We'll answer as many questions as we can in that hour, and then we'll move the rest if we need to the next show. And the Q&A tab is how you submit your questions, and let's jump into it. So what we do is we cover, let's talk about Jill first before we get into the questions. So get out your phone, take a picture of this. This is Jill's contact information, phone number 425-691-5025, and jonesj@columbiabank.com. So thank you, Jill, for being our guest today.
Thanks for having me.
And before we get into things, let me tell you a little secret about Jill. Lived in a condo for 26 years and been on the board for 25. So
I am truly crazy.
What are some secrets that you can share with board members, how to run, just how to stay sane? What's high level stuff? This isn't about loans and financing yet. This is about high level, run a good association.
Absolutely. I think the number one thing is, I don't care what size of association you are, have a really good team behind you. Board members are all volunteers. You're not expected to know all the legalities and the ins and outs of running a community association. And I think just to keep your sanity, just have a really good management team.
Yes. Yeah. Good tips. You have any, what's your best most rewarding story of being a board member?
Oh, that's a tough one, Jen.
Want to put you on the spot.
Oh, that's a tough one. No, of course it is. It's always rewarding to be involved in your community and be able to get things done and just help out. Also, I'm probably kind of a micromanager, so I like to have my fingers into everything. I want to know what's going on to feel perfectly comfortable.
Yeah. Okay. All right. Let's get into it. Here's the 7 questions. We cover the questions briefly, and then we get into them in depth. So the first question, number 1, how much should we have in our reserves if our reserve study hasn't been done diligently? When do we know we need to look at assessments or raising dues? And we always feel like we're catching up. How do we get ahead of it? There's lots of questions packed into there, but yeah, we can break that down. Number 2, I had an inspection. It passed all the tests. A month later, I found rot in my walls, a lot of money for repairs, and a sarcastic, awesome What could I have done differently? Yeah, that's more of an inspection question. I can take that one. Number 3, a lot of our community's owners wanted to sell as soon as they found out there would be construction repairs going on for the next 2 years. Are they allowed to just up and leave when we are in the process of getting a loan and making repairs? Yeah, that's a good kind of board question, and I can sense disclosure issues. Number 4, can lenders or building consultants help us fill out the Freddie and Fannie Mae questionnaire for loans? Well, yeah, we'll talk a little bit about that. Number 5, my condo board sent a letter to all of the residents about the new Fannie documents, asking about deferred maintenance, safety hazard reserve studies. Why are they asking me? Who should we go to for help? Yeah, good question. Number 6, the Fannie Mae form in question number 6 asks if we have a funding plan for deferred maintenance. Does that have to be a plan that's approved by the homeowners? What if we have a plan to present homeowners with various options, but the vote on those options hasn't been held? Yeah, here comes the interesting timelines. So yeah, how should we answer that question? Yep, we can get into that. And final question, the Fannie Mae form asks, did the last inspection have any findings related to the safety, soundness, structural integrity, or habitability? Our inspector did find problems on our building, but is that going to prevent us from getting a loan? And so with all of these questions, we did a simple handout flyer that Brooke can put into the chat, and that answers some of these questions or helps define some of these questions. But we'll get into that later. Let's jump into question number 1. So playing catch up with reserves. How much should we have in our reserves if our reserve study hasn't been done diligently? Well, yeah, this part of me wants to answer it. Well, if I have a sloppy reserve study, the other part of me says done diligently, meaning like every 3 years. So I guess I can answer that in a couple of different ways. Kind of a good safe rule of thumb for me. We look at a lot of reserve studies and work with a lot of boards. And so if you're kind of that gut feel, if you're kind of 70% funded, that has a good feeling to it. I know they don't hand out gold stars for being 100% funded, but I do see a lot of reserve studies that are like 5% or 10% funded, and they just don't have any money. Jill, is there some kind of industry guideline, especially from a bank perspective, or you're going to give a loan? Do you feel good when they're, a little higher? What has been your experience there?
Well, we don't actually look at how the percent funded per se. I like the 70% too. I think a bank would love to go into a loan with an association that has 70% funding. That's
Okay.
rarely the case.
Yeah,
We're
right.
typically looking at the 20 to 30% funding or
Mhm.
less.
Okay.
I think if you're feeling like you're always catching up, then you probably are always catching up. And it
Mhm.
would probably be a good idea to start thinking about possibly having a supplemental budget and building that up over time a little bit extra. How we look at on a lending side is that we want to make sure there is enough reserve contributions going in there on an annual basis that not only will the loan take care of the big major projects, but you'll still be able to take care of those maintenance projects, the recoating of your decks or whatever, during the term of your loan. So it's very important. Do you have to be 70% funded or 100% funded? No, but you definitely need to be funded.
Yeah. And what about, we hear some board members saying, I'm not going to bankroll the future residents, fixes. Just call me when you need an assessment. I don't want my money sitting in some account somewhere. And if I decide to move, I can never get it out. As a board member, how do you deal with that? Or how do you alleviate that fear or manage that fear?
Well, I think that's a great question. And I have to tell you that I used to be one of those owners who said, I'm not prepaying anything.
Right, right.
My building I was an original owner, and we didn't have our first reserve study for 12 years. Well, when I started financing condo remediation projects about 5 years ago, I changed my tune, and I changed it really quickly. That is no way to run an association or your reserves. You may feel like you can write the check, but your neighbors might not be able to.
Right.
And you want to be able to be sure that everybody's treated equitably and fairly, and fund the reserve so that no one's facing big assessments.
Right. And that's one of the powers of a commercial loan, to be able to take this big assessment and spread it over time, like a car payment or something. So it's more of a monthly payment than a big, in 30 days, we expect this big check being deposited into the account. And so, ooh, wow. So that kind of helps manage that. But that feeling of being caught up, or that not, we're always catching up, our heads barely above water, we're trying. I think in previous episodes, I've mentioned the popular, president running for reelection saying, no new taxes under my watch, meaning I won't raise rates or raise assessments. And it's like, guys, everything, especially in this economy, is going up and doubling and tripling. So why wouldn't your repairs, and why wouldn't your costs and fees and expenses? So try to stay caught up. I agree, totally sitting on a giant account and funding all that doesn't make sense, but working closely with a reserve specialist, working with a building envelope consultant, working with a bank to be able to, how much do I really need? And I think that's a teamwork approach. So how do we get ahead of it? Talking about it and starting to plan. So have we plowed this field? You want to add anything extra to this?
I think we're ready to move on.
When do we need to look at assessments or raising dues? Yeah, when most good reserve studies will have a little chart for you that says, in 2025, here's a big spike. That's when the roof needs to be replaced. So kind of looking 3 to 5 to 10 years out and saying, it's fine for now, but is there this big storm coming, and can we manage that effectively? So, yeah. Okay. Next question. Bad inspection. I think this one's mine. I had an inspection. It passed all the tests. A month later, I found rot in my walls. $8,000 for repairs. Not awesome. What could I have done differently? It raises a couple of questions in my mind. First question is the typical home inspection. When you're going through a pre-purchase process, you'll have a home inspector go out, and all of those are visual only. They're not even supposed to move the couch to look behind the couch. And so it's visual only. Here's why: the seller hasn't sold the house yet. It's not the buyer's property. The buyer can't go diving in and damaging the walls and opening things up, and the seller doesn't, frankly, want them to, because if they find something, they have to disclose it to all the new buyers because now they know about it. So that's why all these purchase inspections are visual in nature only. And so they wouldn't be able to see rot in the walls. Now, a trained eye can start seeing stains or, cracks, and we're suspicious about it. And I think in a couple episodes ago, when we had the real estate agents on, I think Monica talked about, you can ramp up the level of inspections. If you do that first inspection, you have more concerns, you can call an engineer and do some more. But especially in this market of waiving inspections and just waiving all contingencies, that it's not very popular. And so the seller's like, you want to do more inspections? Next, here, I got a line of buyers. I'm just going to go with the next person. Another piece, and tying it back to the Fannie Mae form, is it talks about structural integrity. So for me as a building consultant, in order for me to say good integrity on the structure, I have to see the structure, right? So there's other actual laws on the books of actually being able to see the framing or see the structural connections. And in order to do that, I have to pull the siding off. And so back in the conversion condo wars of 10 years ago, some developers would get in trouble with the drive-by inspections saying, yeah, it looks good to me. But actually it had a structural component of it. And it's like, wait a minute, the inspector needed to pull off siding to be able to look underneath, to see the weather barrier, to be able to see the structural connections, et cetera. So think about what you're inspecting to, and obviously invasive inspections would have revealed rot in the walls or mold inside the walls or problem inside the walls. So That's what we could have done differently there. So, and sometimes you can't. Sometimes you have to do the best you can. Do you have anything to add to that, Jill? Is that?
No, absolutely. And when you mentioned the condo conversion thing, there was a real horror story a couple years ago where what looked like a pretty attractive building on the outside ended up to be really a mess once they pulled the siding off, because apparently during the conversion, they just slapped on new siding over siding, and there was a lot of rot.
We're seeing that right now in the flipper paradigm we're in. Of there's a rundown house and it's now made super pretty. It's painted, new flooring, granite countertops, looks marvelous. And now we have all these, no inspections and buyers lined up. And now after they get into it, they say, oh boy, what did I buy? And so, yeah. So, yeah, this is a real deal, but there are ways to get through that. So, all right, next question, disclosures. Okay, yeah, this is a good one. A lot of our community's owners wanted to sell as soon as they found out that there would be a construction repair going on for the next 2 years. Are they allowed to just up and leave when we are in the process of getting a loan and making repairs? No, lock them in their unit. Don't let them leave. No, I shouldn't say that, but joking. Yes, of course, they're allowed to come and go. It's their unit. They can sell, they can move on. The issue here is disclosure. They know a potential assessment might be coming. They know a project is coming. And then even especially if they're on the board, they really got to see the consultants' reports and maybe some contractor bids, and they got to get an idea that this would be $1 million project. And then all of a sudden they moved and sold. We see that a lot. What is being on a board, Jill? What's your, you've seen it happen.
Oh, absolutely. And I just have to kind of chuckle because actually there's been some work lately in our building, and I kind of, jokingly say to the project manager, please let me know if you find anything.
Yeah.
But I guess what I'd say to that. Obviously, anyone who's going to buy a condo, they should definitely be looking at minutes and things like that to see if there's anything going on. But as far as owners wanting to leave, what I would say is wait until it's complete. The value of your property is going to go way up. Just hang in there and sell. And that's the one advantage with having an association loan. You can just make payments until it's complete and then put it on the market, and guaranteed you're going to get far greater value than if you try to sell with with work that needs to be done. The other thing too that I have heard owners be concerned about is having an assessment, having the assessment already in place. You're far worse off for an owner, potential buyer, to know there's a problem, but the assessment isn't in place. They don't know what they're getting into. So you're really way better off. Get the work done, get the assessment in place, get it financed if you can. And then the owners, if they're smart, will stick around, wait and sell, have some options anyways.
Yeah, you brought up a couple of good points. The first point is we all, especially growing up or, buying that next house, we all buy the maximum, even beyond the maximum. And we just got into this great place. And then all of a sudden we're being asked to fork out another, big assessment, and it might break us. It might put us under. And so I imagine you as a lender would be very interested to know who just moved in and can they make a little bit bigger payment. The second thing you brought up is actually a personal experience. My father and mother in-laws, at the end of their life, their condo was going through an issue, and they asked me to kind of take over. Hey, you're experienced at this. Can you help us through this? And guess what? I got adopted to the board. The board was very excited to have a building envelope consultant on the board as a volunteer through this construction process. So I saw that, but I saw we had a big assessment. We had a big $70,000 assessment, and we were kind of nervous about it. But I saw hey, during the time of construction, it was interest only. And then by the time the construction was done, we had kind of fixed up the interior and got it ready to sell. So we only had a few payments to make afterwards. And it wasn't, you think it's that $70,000. I think we probably paid 10. And then we were able to negotiate the remaining assessment with the buyer. And that was really easy. It wasn't a big pill, and you didn't have to swallow it immediately. And it was a lot easier. And property values went up 40% and just over time. And now the building is new again, and it looks great. And so, yeah, and counseling people to just stay tuned if you can. Don't sell when it's an absolute disaster and all torn apart and then under a construction zone. That would be the worst time to sell it. So, yeah, good point. Okay, next question. Can somebody else just help us fill out these forms? That's what, can lenders or building consultants help us fill out the forms? And I think that was we walked through in the last episode of this form specifically. Form has about 12 questions. I think 2 or 3 of the questions, or maybe a third, the consultant can help you with. Maybe a couple of questions the bank or the lender can help you with. A couple, 3 questions the manager can help you with. But the remaining bulk of it, the boards really need to get together and make a plan, because a lot of the questionnaire is, if you have problems, what are you going to do about it? Or if you have problems, how are you going to pay for it? And as a board, how we're going to pay? Well, that's going to be in our budget or in our special assessment. And both of those usually require a vote, or in the negative vote if the budget gets voted down. So it's a process, and we can't do all of that for you. Jill, what's your input on that?
I agree. I think a lot of that is filled out by the resale certificates filled out by the management companies, but definitely, based on information obtained through the board. Also, as far as a plan and funding these projects, the Fannie Mae and Freddie Mac definitely do consider that an association loan is a funding plan. So if you have obtained an association loan, that solves that issue right there.
So that's how we're going to pay for it. That's the plan. And you brought up an interesting piece of, I think of a plan as a project schedule. So every construction project has a start date and a finish date somewhere, 10 months later. It's out in the future. We're doing the best to say we're going to be done with this building or this phase or this task by that date. It's not for certain, but it's the best kind of plan you can have at that time. And so we're actually coaching boards to kind of think that way and say, well, I need a scope of repair by this date. I need a bid by this date. I can then go vote and get the money by that date. Then I can start construction by that date. Assuming I get yeses all the way through, we'll be fine. If I happen to get a no, well, then I need to change this current schedule. But as of right now, at this point in time, here's my plan. And so that's how we can help you work together and fill this out. The other thing that came to mind was, I was talking to a manager the other day, and there's third-party vendors out there that help management companies put together resale certificates or put together sale documents. And it was interesting. They said this particular vendor got together with their in-house attorneys, and here's their responses. Let me share it with you. And so I started looking at it, and they're very lawyerly. One of the questions is, name all the code, different building officials that have had code problems on your building, or know of any code problems about your building. And it was very lawyerly. We don't know of any, but you're welcome to call all the building departments and see if we have any violations. So putting it back on them, and it was kind of question after question just like that. And I was like, this is just frustrating me reading it. I can't imagine. I'm trying to get help filling this form out. And so it's a real thing. You have some partners that say, we're not going to give you any answers. You guys have to figure it out. But this is part of this educational content that we're trying to help you. Here's how to do this. We're not going to tell you the answer, but here's the process of getting that done. So, all right. Next slide is chat with Jill time. Here's the commercial interruption. It's talk one-on-one with a lender. Does any of this stuff make sense to you guys so far? Are you getting some kind of tidbit and want to talk to Jill a little bit more? Because she's been a board member or is a board member, she has extra credibility. So give her a call after the webinar. Again, her direct line is right there. Pull out your phone and take a picture of this information on the screen right now while I take a water break. Okay, there we go. All right, next slide. Maintenance and safety hazards. This is an interesting one. Board sends out a letter to everyone asking about deferred maintenance, safety hazards, and reserve studies. Why are they asking me? Who should we go to for help? And so this is kind of an interesting question. There's nothing on the form that says you must survey your HOA. One of the questions says, does the board or manager know about any of these problems? And so I think this is a the heart's in the right place. Hey, let's ask everybody. Let's see if anybody knows about anything, and we'll disclose it. But I think that's what it is. It's just kind of a general, hey, does anybody know about anything? We're trying to get caught back up because our records aren't quite complete. And this is kind of a problem that we see of, board transitions to a new board, doesn't get any records or data from the last board, or manager transitions, same thing. And so brand new board has no history unless you have a lifer, 25-year lifer like Jill on the board that stays with it and brings the historian knowledge with her. And so, and that's one of the things that, we learned through the Surfside thing. The board got bad news. They all quit. Go back to that last question. They all quit and moved. Nobody, they took all those reports with them. So new board steps in and doesn't have any information. They all quit and leave, or they, kick the can down the road. And so for years, these things were just kind of bouncing around in the ether. But anyway, so that's what they're trying to do. I don't think asking the residents, I don't think it's a requirement of the form, and I don't think it totally helps other than the big picture of, does anybody know anything? Please let me know. So
that's a good point, Jens. I kind of wondered when I saw this question, like, what the heck? But when I think you're absolutely right. I think it has a lot to do with institutional knowledge and who has it and who doesn't. And things just don't get handed down and records are lost. So probably good point, because I was thinking the same thing. Interesting.
Do you have a good tip for boards to transition? How do good boards share knowledge when people don't stay on forever?
Well, that's why you have the original owner who's still on the board after all these years.
Yeah.
It's hard. It is. It's really hard. And hopefully, you have a good management company that's also has good records. But like you say, those change. But yeah, so it's difficult.
Yeah. Yeah. Okay. Easy question. Number 6. Okay, the Fannie Mae form question 6 asks if we have a funding plan for deferred maintenance. And does that have to be a plan that's approved by the homeowners? And what if we have a plan to present homeowners with various options, but the vote on those options hadn't been held? So we kind of talked about that, but one thing I'm going to jump ahead of, and that's talking about the form asks about deferred maintenance. The form doesn't really ask about maintenance. Maintenance can come out of your budget, but deferred maintenance, how Webster and Google identify that, is something that you knew about, but you didn't take action on. You pressed pause or said, we're not going to do it right now. We'll do it next year. And so that would be, hey, we need a roof. Let's go get 3 roof bids. Whoa, it's that much money. We don't have money for that right now. Let's pause on that project and push it off to later, defer it. Another deck coatings. Hey, some decks are starting to get blisters. Let's recoat all of them. Oh, we don't have money to do all of them. let's just do the blistery ones and maybe fix an occasional deck now and then, but we don't have any money. And so you know about a maintenance issue, but you don't deal with it. Now it becomes a deferred maintenance. Does the commercial lending side of things view it as that way, or is it all maintenance? How do banks look at that?
Yeah, we definitely look at what deferred maintenance is out there. And if it's not being financed, we want to know a plan too, or else we're not going to be able to finance that big major reclad project or window replacement project. If we see that 3 years or 4 years into the loan, you have a roof, or maybe the roof right now needs it, and you're just going to kick the can because you want this project. That's going to be a challenge for financing, and we're going to want to see that deferred maintenance, enough of an assessment that you can take care of that.
Yeah. So again, it's that, and a lot of boards split this up. We'll do the walls now, or the walls, windows, decks, all that stuff now, and we'll do the roof later. And so again, looking at that reserve study, if you see that spike in 3 years, you need to do a roof anyway. So we've got a loan to cover this stuff, but will be a 7-year loan that overlaps in 2 years. I need a roof. And so that double hit. And I think we talked a little bit about that, but if we have a plan, we talked about the financing plan being that plan with some options, but the vote on those options hasn't been held. We kind of talked about that. You can have dates on a schedule saying we're going to have the vote, we're going to do this thing, here's our options. So I'm starting to look or paint a picture of more of a long schedule, more of a long range thing. So people should be reaching out to you right now, Jill, for projects in 2023 and beyond. I mean, we should start that conversation, right? Because we have to start putting together this thing, right?
Absolutely.
Okay. So do you find that it's best to call you 6 months in advance, 2 months, 6 months, 18 months? What is it best to call you in advance of when I know I need funds?
Oh, I would suggest, so a lot of these big projects do take a while. And as soon as you have a major project, I would be contacting lenders right away. One, to make sure to see what you could qualify for, because it's not just an open checkbook, right? There's going to be only an amount that the lender's going to be willing to lend an association. So get in the conversation early, and a lender can help you prepare to get a loan and to know how much. Maybe there would be like what we call a funding gap. You can only borrow so much. So what does this association have to bring in? So I would say at least 12 months, although, in fact, this year's been a little different in that we're not getting that 12-month lead time. And
Right.
I think a lot of it has to do with this Fannie Mae thing that's going on right now. It has really kind of opened owners and board members' eyes that this is pretty serious, and we have to start taking care of these things.
Yeah, I think it used to be, we could kind of ignore is the wrong word. I saw a lot of boards kind of poo-pooing the reserve study. Oh, it's a nice accounting exercise. It's a nice estimate thing. It's nice to put some time limits on some things, but it's not reality. We know we need a roof when it starts leaking, and it's he's estimated that the roof will last 5 more years, and we'll hopefully have enough money by then. And so, or I'll see the really cheap, hey, we're required to have reserve study, so we're going to get the 1995 do-it-yourself reserve study. Look at me, I found an Excel spreadsheet online. We can just enter in our own stuff and not call a reserve specialist. And so that gets back to that first question. My reserve study wasn't done the best way. And so that helping the board say, look, here's our foundation, here's our background, here's our baseline. Now, what's wrong with the building and how do we fix it correctly? And then go talk to the bank to try to fill that difference. I recall other lenders saying, don't even call me till you have bids back from contractors. And I remember being a little confused by that, but they said, if we don't have a target, we don't know what to hit. And you mentioned it, we can't, it's not just a blank checkbook. We need to understand what they're doing. So, I guess I can see both sides to that, but how would you speak into that of?
Well, I think that's a good question. I think, I obviously you couldn't get a firm quote until you knew exactly what this was going to cost.
Mhm.
But it's not a bad idea to find out, well, based on our situation today, what would it look like as far as what's the maximum you could lend our association, and what do we need to do to clean this up? As far as when I'm talking to boards about, based on our criteria, here's what I think you could borrow. I mean, don't go telling a contractor that.
Sure. Yeah, gives them a target.
But, I mean, it's usually there's a ROM that's involved or some guidance. It might be, hey, they've already estimated some expenses for insurance or whatever, but there's usually some number floating out there. But worst case, I mean, I have no problem talking to boards really early on without firm numbers, just so they can plan.
Right. And it's kind of the consultant figures out what needs to be fixed. The contractor puts a price on it, and then the bank says, can we get these prices? And we're actually seeing these timelines not be A, B, C, but maybe A, B together or A, B, and C together. They're kind of sequential now, kind of moving side by side and walking through the process instead of 1 step, 2 step, 3 step. And maybe getting together early and saying, here's what we can do and help. Because as consultants, we can say, here's what you need to do to your building. Can we push off some of that to maintenance? Not necessarily deferred maintenance, but okay, yeah, let's look at your reserve study now and say, yeah, you've got some room to do this next year. And then, be able to communicate that to you, the banker, saying, here's what we're going to do. Here's how we're going to tackle this. Here's how we're going to handle this series of projects over a loan's lifespan, and be able to kind of work together on that. So, like I think you said in the beginning, have a strong team. So, yeah. And then powers of reserve study. Do you have comments on that? Just reserve study being more important than we think, or not?
Absolutely. Probably one of the most important things we look at. It is absolutely critical to underwriting a loan to an association. And I always tell board members too, a lot of times people get the reserve study and don't pay any attention to it, or just throw it in a drawer. We've got to do it. Okay. Take ownership of it. Really look at that thing, know what's in it. A lot of times when I'm underwriting a loan and I see in the reserve study, it says this comes due, I'll get, oh, no, it doesn't. No way. It's like, well, have a conversation with whoever's doing your reserve study, because we're going to have that conversation. This is what we have to go on. It says that this work needs to be done. So do take ownership of it. If there's something you don't agree in, if you see something's missing, almost always you see a draft, you get the chance to make revisions and before it's finalized.
Right. Yep. Good. All right. Last question. Let's see. The Fannie Mae form asks, did the last inspection have any findings related to the safety, soundness, structural integrity, or habitability of a project's buildings? Our inspector did find problems on our building, but is that going to prevent us from getting a loan? Is it going to prevent us from getting a loan, Jill?
I think this might be referring to getting a mortgage, and it could.
Well, maybe from the commercial loan either.
Yeah, absolutely. Well, and hopefully if there was deficiencies in the inspection, that's what's driving the association to look at how much money they need to fix it and to get financing to do that.
Right. Yep. And I think after working with lots of boards and lots of banks, it's not going to typically prevent you from getting a loan. It's just, what's your plan in dealing with it? And again, that's the whole melody behind the Fannie Mae form now of, tell us what you know about your building and how are you going to deal with it, and show us some kind of schedule or some kind of plan that we can look at. And so, there was just something on my mind. I forgot what it was, but this is, I think we've answered the questions there. So, yep, go on to the next one. Okay, the other commercial interruption is a clarity call with a building doctor. So again, get a call with me, get answers for your building and board, take a picture of this slide, get a QR code scan. We can get you our contact information any way possible. But check out our website and we have links there as well. So have your little, call us up, see what's going on. We're going to put you into this decision-making process, whether you want to or not. And so, yeah, as we wrap up, before we get into the Q&A, it used to be, prior to this form and prior to all these requirements and prior to disclosing all this stuff, the commercial loan process was the big pain, and the board anxiety would go up and they'd be like, I gotta get all these things, I gotta turn all this information over. So now commercial loan processing isn't the bad guy anymore. It's this form to make you really stop and think and do. But if boards can be ready for this information, what is it going to do to the loan process, Jill? It's just going to make it fly right through, right?
Right. You're absolutely right. There is a lot of information. It's just like when somebody goes to get a mortgage and they have to give all their tax returns and all their statements and all that. It is a pile of information the lender's going to want. So actually really kind of not a bad idea. And when you start talking to lenders, that you just start compiling all that information, put it in a folder. It's your, lending folder, and then you're ready to go.
Yep. Okay. All right, let's get into the live Q&A. So I see 5 questions. Let's jump on this first one. We will be looking at acquiring financing for a condo siding project. What is the outlook for rates with the Fed looking to continue to increase rates? Are there variable rate programs that we should consider to hopefully have rate decrease? Ooh, good question. Jill, this is yours.
Oh, that is a good question. Well, I'd love to tell you it's not going to affect rates, but it is.
Okay.
So our rates are not mirroring what mortgage rates are doing right now. It's kind of a flip-flop. Our commercial rates are less than what you'd go out there and find for a 30-year mortgage right now.
Wow. Say that again.
Yeah, they're less.
It's never been that way.
They're less than what you are finding right now in the mortgage market. So we're a little behind in that respect. But will say that they've gone up probably 1.5% from what we were seeing, just 6-7 months ago. So no question about that. But honestly, our rates right now are still lower than what they were before the pandemic.
This goes against 25 years of working in this market. The old way to do it was go get a home equity loan, go get a second mortgage, and so you guys came out with, we'll loan to communities, and it was always a point or two higher. And so people would do that math and go, well, I'll opt out of the community loan program, but I'll get my own loan and write a check. So you're less than mortgages right now.
And you know what, that's such a good point, Jens, because last year or during the pandemic, when mortgage rates just plummeted, I like to tell this story. I had a $3.5 million commitment out there. And when we make a commitment, we know owners are going to pay off in full. You don't have to borrow all of it. It's just there in case you need it. I ended up loaning that association $400,000 out of a $3.3 million project because the owners just went out and they were like yours, $30,000-$40,000 or whatever, because the refi were so low. We're going to see that flip. Because right now our rates are pretty good. They will probably go up again before the end of the year. But anyways, yeah, they're still pretty good, still affordable. And again, I know a lot of people are panicking, but people were loving this rate 3 or 4 years ago. Right. So it's still not bad. Now, I will say, I'll answer the other part of that as far as variable rates. For the longest time, because rates have been so low, and this is going back quite a few years now, we would always fix the rate for up to 10 years. Just and it didn't make any sense to do a variable rate because the rates were low. Lock them in. They're
Mhm.
still that low that I would think you would want the longest fixed rate you could get. However, it used to be quite common where if you had a 15-year loan or even a 10-year loan, you might do a fixed for 5 and just reset it every 5 years. You might
Yeah.
fix it for 3 to kind of get that down. I will say that, when rates decrease, you can talk to your lender about refinancing at a lower rate.
Yep.
We saw a lot of that before the pandemic started. It was just a few years ago where things were doing the opposite, where rates were dropping so fast that it seemed like by the time I issued a term sheet, the rates were even lower. So there was a lot of occasions where we went out to our clients and we lowered their rate. So I wouldn't worry about a variable rate yet. I don't think the rates are high enough to want a variable rate.
Yeah, but get locked in if you can beat the second mortgage rate. Holy smokes. Yeah, that's fantastic. Excellent question, James. Thank you. Okay, next question. We're a 15-unit townhome complex that will need a complete facelift in the next year or so. Half of our residents want to get personal loans so they can write off the interest. What is the advantage of taking out an HOA loan versus a private loan? Yeah, Jill, back to you.
That's a really good question. There's a lot of advantages and that you're exactly right. It's not interest to the owners for association loan. Here's the pros and cons, of course. With a home equity loan or a refinance, you're going to have all the fees that are associated with that. You're going to have a lien on your property. You're going to have credit checks. Some people aren't going to qualify or have the equity for a home loan or a refinance. But if they do and they want to go that route, that's great. The bank doesn't care, right? The advantages to the association loan is there's no lien on your property.
Mhm.
There's no guarantors. It doesn't affect your credit. There's no all those underwriting fees to you individually associated with it because we're actually making the loan to the association. It's not to individual homeowners. So you have your choice.
Yeah, and that's a good way to look at it. And everybody's tax situation is different. So, you'll have to go talk to your accountant or figure out if it's better for you to get a second loan and write off the interest or yeah. And I mean, back in the day, if it was a 15-unit thing, we'd have 15 individual liens. It was just kind of a beast to manage. And this new program is one association lender and one loan, and everybody pays into it. So kind of a follow-up question on that is we're in the same complex of the last question. And we have voted on and approved a special assessment amount only to find out that this amount may not cover the expenses of a growing project. It was a stretch to encourage owners to vote for the dollar amount. Any ideas on how to better nail down a dollar amount with costs rising so quickly before we go back to the homeowners? So that's kind of in this rising time of inflation and costs and labor. All that stuff is kind of crazy right now. And yes, we finally get the loan thing, then we have to wait till next month for a vote, and then we have to wait till next month for ratification of that, whatever. And 60 days goes by and the contractor says, I can't do it for that price anymore. I was talking to a roofer today of, can I order the product today? And I said, I have to get the owner's approval tomorrow. And well, the supply house said they might run out or it's going to, so anyway, that's a real deal. And so Jill, how does Columbia deal with a little bit of an escalation clause due to, we know there's inflation happening daily. So do they automatically get kicked out of their loan or can there some review happen?
Oh boy, it's a real deal. It has been so tough. So I feel your pain. And so if you're early in the process, what I would say to you is you're going to just have to pass a special assessment with a chunk of contingency in there, a really, really healthy contingency. hope you don't need it. And you know what? It never hurts to have more money in your reserves if you don't have to use it. I
Mhm.
will say that many times over the last 12 months or so, they've been over budget. And yes, typically, they pass an assessment based on the budget, and now you're over. And so how we've been able to manage it. We find ways to give them more money, but it does require having to go back to the owners and say, owners, we're a little short. The bank's willing to give us more money, but we have to pass an additional special assessment to make up that shortfall. Now, you still get to finance it. It's still over, the period of time, but it's a real deal. Tons of contingency. That's all I can say.
Right.
And you just have to convince your owners that that's what it's going to take.
When we help boards put together a project budget, it's the contractor costs, it's our contingency that's saying, hey, remodeling is always full of surprises. We're actually putting in an inflation escalation contingency amount just because it's sign of the times. And like you said, you don't have to spend it all, or you could put it into reserves. But nobody likes going back for round 2 assessments. It is totally unpopular and it's stressful. So yeah, good question, Darcy. Let's see. The next question: can the board acquire financing for needed envelope repairs, or does this require an owner vote? We see your bylaws have to give you the authority to borrow. And so most bylaws, let's face it, they get born into existence to benefit the original developer. And so then over time, the board revises them with revisions and rules and other bylaws and amendments and things like that. And so one thing that we walk boards through is, hey, let's get with your HOA attorney, the attorney that helps you write tickets and fines and helps you deal with things like that for HOA needs. Let's get an amendment on the books to allow the association to borrow. And then once that's passed, then they can go talk to Jill. Jill, is that your understanding of that?
Yeah, exactly. A lot of the declarations do already have the authority to borrow, but
Good.
definitely good. Yeah, a lot of them do.
Okay.
A lot, though, do have to pass an amendment, and that requires a certain vote. As far as your project itself, if it is a repair, and I'm not going to, I'm not a lawyer, but if it's a repair, you typically don't need an approval for a repair. But you will need to ratify a special assessment in order to pay for the project. So
Right.
yes, the owners in a way do have a lot to say about it.
Yep. I think what you're referring to on repair is repair versus what's called capital improvement.
Yeah.
So repair means I had rotten leaky siding, I'm putting on new siding just like I had it. Capital improvement means, and while I'm doing that, I'm going to add a pool. And so you're doing something to increase the thing. So yeah, in that particular, if you're adding a pool, building a clubhouse, whatever, definitely it's a different part of your bylaws. But again, your HOA attorney can walk you through that. So
And you want owner support. You want as much owner support as
bingo.
possible.
And yeah, it's when I'm talking to boards, it's like, well, we don't technically have to take a vote, so we're not going to tell them. And I'm like, oh, geez, no wonder your owners hate you at the mailbox. And so let's get everybody on the same page. Let's communicate well. We're in this together. Here's what's going on. So yeah. Okay. Yeah. Good question, James. Last question. Our townhome owners are divided on funding for a big capital improvement project. We have one group wanting to get an HOA loan, and we have another group who want to pay the special assessment lump sum on their own. Can you blend these two funding options? Yes. Yeah. So what my take on that, and we see that of the loan is just an ability to spread that special assessment over a period of years so that everyone can participate. If somebody doesn't want to participate in the loan process and reach into their left-hand desk drawer and write a check, like we talked about this early on, great, they can do that. It's called a prepay. And what happens there's always a percentage of prepays. And as you start the project, you may have 20% of the budget's already prepay. So that first 1 or 2 or 3 pay applications, we're taking that out of prepay. You haven't even started borrowing money yet. You have pre-approval, but you haven't even started the ticker from ticking on interest. So then by, the mid of the job, then you start pulling the loan out. And so there's some nuances of, just because you paid up front doesn't mean, like we said, we're going back for a second round 2, you'll have to pay that round 2 as well. But you won't, if you won't have to pay the interest, you won't have to be a part of that process. You can write a check. So Jill, what's your take on that?
Wow, you did that really well, Jens.
Oh, hey,
Some
well.
more of my meetings. No, you know what? I like to describe my commitment as an insurance policy. Basically, you need to know you have those funds available so that you can sign contracts. And worst case scenario, nobody writes that check. The bank is willing to give you the money, but we have no minimum amount of that commitment you have to take. So typically how you see this work is, all right, owners, here's your share of the assessment. You have 90 days to pay it in full. You're done. For those of you who don't want to write that check, here's the monthly payments. So yeah, absolutely. It's still all one loan. It's still all nobody's treated any differently. It's just not everyone needs to take the monthly payment option.
Right. Yep. Okay. Perfect. All right. I know we're pushing up against our hour, so I thank you everybody for listening along. Those were great questions. And so, yeah, we want to jump to the fun part now, giveaways. And this is where J2, let's see, what are we giving away this month? The J2 brew continues to be a popular hit, energizing your community since 2007. It's very good. It's a dark blend. It's yummy. And we're going to give you a J2 tumbler. You can, of course, put coffee in there, but it also works for wine and anything else you want in the afternoon. So how we do this is your attendance is listed out, and Brooke will be looking at that. And so I'm going to pick, and I'm not looking at participants, I'm going to pick participant number 5 gets the J2 stuff. So Brooke will notify you. Jill, what do you have today?
Jens, you picked my number.
Oh, sorry.
Well, in honor of the most horrible, wettest June on record, I've got an umbrella and a little coffee card to go with it. But since Jens took my favorite number, I'm going to go with number 8.
Okay, awesome. Number 5 and number 8. You are the winners. So thank you for watching that. And again, thanks for attending. So again, take a picture of this. Here's my contact information. Schedule a call if you want to bounce ideas off that. We call it a consult call. It's free. It's 15 minutes. Ask us any questions. Jill's doing the same thing. Take a picture of this. Here's her information. And if you heard it, she said, call me early, and we will walk through this stuff with you. So thank you so much for attending. And don't forget, we're back at the end of each month, last Tuesday of every month. Invite your friends, and thank you for being here today. So happy rest of June, everyone. Thank you.
Thank you.
Thanks, Jill.